They tell you a trade war is about winning, about protecting jobs, about making the other country pay. But what if the entire economic argument is a lie? What if the tariffs, that tax on foreign goods, are really a tax on you? The truth mainstream media never explained is that tariffs don't just shift markets. They fundamentally break the global supply chains that hold the modern world together. Like and subscribe to The Lazy Economist for more cinematic explanations of how money really works. The core issue is that the world economy is no longer a collection of distinct national pools. It is a single interconnected ocean of value. President Trump has proposed and in many cases implemented tariffs up to 10% on most imports, with threats of up to 60% on certain countries. Economists estimate that a universal 10% tariff could reduce global GDP by as much as 1%, enough to tip an already shaky system into a full-blown downturn. This isn't just a political argument. This is a cold, hard lesson in economic physics. When you slow the flow of goods, you starve the economy of energy. The real danger is not the tariff itself, but the multiplier effect that follows. The core problem can be explained using the metaphor of the car assembly line. A modern car part might be designed in Germany, made from steel forged in Brazil, stamped in China, and assembled in Mexico, before being sold in the US. Tariffs are like putting a tiny tax sticker on the middle of this process, say on the Chinese stamping. The US consumer doesn't just pay a tax on the Chinese part. The US automaker now pays more for its input, raising the final price of the entire car. This cuts sales. The tariff intended to punish one country is actually a hidden tax on American businesses and consumers. This price pass-through is undeniable. Let's look at the real-world tariff impact. Step A. The initial American tariffs are implemented. The political narrative is that China will pay. Step B. The data quickly shows the burden falls almost entirely on American firms and households. U.S. importers absorb the cost, and they pass it to the consumer. The result is higher inflation and decreased real income for American families. This is a demand shock. People buy less because everything costs more. But the global recession is not caused by the U.S. alone. It's caused by the predictable retaliation from other countries. The system behind the system is the Trade Multiplier Effect. A large country like the U.S. raising its tariffs sends a shockwave like a stone dropped in the global pond. Other nations, from China to the EU, don't just respond with equal tariffs. They respond with tariffs designed to hit politically sensitive U.S. exports like soybeans or autos. This isn't measured in tariffs, it's measured in uncertainty. Business investment, the money that funds jobs and innovation, freezes up entirely. The mechanism that triggers recession is not the cost of the tax, it is the cost of fear. What is the financial framework for surviving an economic war waged by governments on their own citizens? Rule 1. Stop buying the narrative. Tariffs are inflationary, meaning they push prices up. You must hold assets that thrive in a high-cost environment. Rule 2. Look past the stock index. The S&P 500 is not the economy. Your portfolio needs decentralization, away from the most exposed, efficient global supply chains. This means favoring businesses that source locally, services that cannot be outsourced, and assets that cannot be taxed by a government looking for revenue. The market rewards intelligence, but the system rewards localization. The financial media frames this as a battle between two countries. But that is the wrong analogy. This is a fight between the political desire for protection and the physical reality of globalization. The world has achieved peak efficiency. Tariffs, trade wars, and protectionism are the friction that turns growth into stagnation. They are a deliberate, conscious attempt to make the machine run less well. The truth is, there are no winners in a trade war. The American consumer loses, the foreign exporter loses, and the global economy loses the one thing it cannot afford to lose: trust. The market doesn't reward politics, it rewards the undisturbed flow of value. The next recession may not be caused by a housing bubble or an oil shock. It will be caused by the simple, willful choice to abandon cooperation for conflict. Your job now is to position your assets and your career outside the line of fire, to build a financial fortress while others focus on political victory. Subscribe to The Lazy Economist for weekly cinematic breakdowns of money, markets, and the machinery behind them.